Hello, everyone. Welcome back to the world's best investing podcast. It's on everyone's mind. The top question is the quote unquote bubble popping? Today, I'm going to be making an honest assessment of the situation and whether we really are in a bubble and what's the likely outcome over the next few years. Let me start with saying something. If you cast your mind back to 2022 and you were in the scene, the whole tech investing scene, you may remember some people saying Palantir was overvalued. You may remember some people saying Spotify was overvalued. So valuation, it's if you looked at those companies by any metric, it wasn't obvious that they were actually undervalued. Time has proven that they were. And even if you assume Palantir's valuation, fair valuation is 50% less, which we'll address that now, still massive upside. Same case with Spotify. And so the point is, negativity always resonates more with the average human. And what I'm going to say is not going to increase my likability points, but it's about making money and it's about picking stocks. Social life is separate from investing, and that's something that's very important to understand. But basically, if you want to be in a lot of company, you have to be largely mediocre and inspire pity. And if you if you want to win, you sort of got to let go of that. And so what we are seeing here, if you look at the earnings, is fundamentals are strong. Investors are not. Investor psychology, the average investor turns self-destructive when things are going too well. So it's actually harder to hold stocks when they go up than when they go down. When they go down, people feel miserable, and that is the average normal state for a lot of people, unfortunately. And again, I'm not increasing likability points, but it's about making money. And I think that ultimately people that do want to make money will appreciate the honest nature of my remarks. And then when things are going well, people feel worse because a lot of investors do not believe that they actually deserve wealth, which I believe every single human on earth does fundamentally. And so look at the graph that I'm putting on the screen now. You will see that Palantir's quarterly revenue growth is accelerating, and this is happening as it gets bigger. What we see here is the law of large numbers doesn't apply. So let's say you believe Palantir's fair valuation is actually 70% less, which is a fair assessment. It's a reasonable opinion. As I'm saying, it's going to get you friends and it's going to get you in company. Not necessarily good company, but you're going to have a lot of people agreeing with you and so forth. But if you look at that number in Q3 2025, quarterly revenue growth came in at 63%. And if you look at the progression and you understand the fundamental drivers of it, that assessment, if you do indeed believe that the fair value is 70% less, it might actually be a foolish move to bet on the valuation contracting that much. Firstly, because it requires timing. I do appreciate that someone has to do it. I do appreciate market mechanisms, and actually the opportunities are thanks to the bears, not despite them. So I do appreciate that. But the reason this company is accelerating as it gets bigger is that its operating system is getting verticalized. And so what that is doing is reducing the time to value. As the time to value is collapsing, the total volume of deployments is going up, and so Palantir has more data. Then they use that data to productize the offering further. And so we're seeing verticalizations with Warp Speed. We're seeing it now with Vantage, which is like it's an instance of Palantir's ontology just for the Army. And the Army recently issued a memo saying that all Army branches should migrate to Vantage right now. And so what you're seeing is this sort of infinite fractal verticalization of this ontology, time to value tending towards zero. And that ultimately means that Palantir is exponentiating their volume of business as they move forward. So now we have AI FDEs, which automate some part of the function of FDEs for deployed engineers. We also have Edge Ontology, which is a lightweight version of the ontology, which is now able to run on the edge. And so this thing is moving in a direction in which Palantir goes from powering companies to eventually supply chains, industries, and then nations even. And so even if you assume the fair valuation is lower, my point is the fundamentals are soon going to very quickly come and bite you in the ass. It's understandable that people are sort of second guessing this thing because it's a non-linear process, and that is just not how our minds work. And then if you combine that with negativity resonating, especially in times of self-destruction, which is when things are going too well, you see that in civilization. When civilization does very well, eventually you have a sort of self-destructive OS that emerges. That's what we've seen over the past few years, right? So again, if you look at this graph, there's sort of no it doesn't really reconciliate with the sentiment at the moment. It's really, the limitation is not in the fundamentals, because AI capabilities are doubling every 2 months, and Palantir's earning power is scaling in tandem with AI scaling laws. The limitation is actually human psychology at the moment, and the tendency to be gregarious and self-destructive. However, on a positive note, what I do think is that earnings take these companies, the valuations, higher over the long term. So if we go back to April, many respected finance voices were saying it was the end of the world. And a few months later, with the stock market much higher and company valuations much higher, they come with a new narrative, which is, okay, the market is hot, but it's a bubble. And to me, all of this is superficial. To me, all of this is the hubris of the traditional finance system, which really relies on customer fees. And so you, as a customer of this thing, if you fall into the traps of the machinery, which is getting you excited or sad with a quarterly cadence and sort of following narratives and stuff, you're going to be drained in the form of fees. So the way you actually make money in the stock market is by holding an extraordinary company or extraordinary companies for the long term. So this company has returned my entire portfolio more than once. So has Spotify. I really don't care if the valuations go down 20, 30, 40, or even 50%, as we saw during April. I don't mind, because I think the valuations continue outpacing narratives and current valuations. Fundamentals continue outpacing valuations. And so if you look at what's happening with the hyperscalers, they are printing more cash from operations. Free cash flow is inflecting downwards because CapEx is going up. But if you listen to the remarks of these managers, what they are saying is that as soon as they deploy additional capacity, it's being consumed. That's what Andy Jassy was saying. Andy Jassy also shared that when an Amazon e-commerce customer uses Rufus, which is Amazon's shopping AI assistant, the likelihood of a purchase goes up 60%. It's a very interesting thing, because 60% likelihood, additional likelihood of shopping at, say, benchmark today, ChatGPT 5. If you project that out into the future, how much incremental likelihood of buying is there with, say, ChatGPT 10? That number, there is no reason for which it can't get to 99%, because what these nets are doing, neural nets, is understanding our psychology better and better, which is ultimately why Meta's family of apps is increasingly addictive. That I'm not so much a fan of. That is why people are looking at their screens more and more. So the world is headed in that direction because, among other things, neural nets are very good at capturing human psychology and understanding it. So I didn't quite endorse Meta as a pick in 2022, but I did with Amazon, because I believe Amazon does a much better value addition to society. And so if you think about it, Amazon's e-commerce business is driven by two things, which is capturing demand and then being really efficient in the supply chain. And if you increase likelihood of purchase by 60%, and you can do that in a relatively lightweight manner, which is really just by deploying new models with more parameters as they come out, that's going to be highly, highly accretive to the business. And then generally, I don't believe the future of AI is evenly distributed. I think there's going to be winners. But if you look at Palantir, winners and losers. But if you look at Palantir, for me, the fundamentals are black and white. And as I was saying, when you're dealing with a company that's evolving exponentially, linear deltas in valuation and stuff is a very dangerous game to play. And I don't think it's going to work well. I think it gets you friends, but I don't think it works. And if you look at other companies, like, for example, Duolingo yesterday, I don't think... So contrasting the fundamentals yesterday with investor sentiment, they are black and white too. So the fundamentals were doing great. They said they were going to prioritize teaching quality over user growth and user growth over profitability. And what people don't understand is that this company has a marvelous track record of focusing on these three metrics intermittently, while giving each metric or each aspect of the business a great deal of focus. And so, as I said yesterday, in Q2 2021, the growth, daily active user growth, halted basically to zero in Q2 2021. And then 2 years later, it was at 60%. And people were asking today on X, well, what happened? And the truth is, nothing happened. These guys were just focusing on another metric, which they believed maximized long-term value versus other metrics. And then they came to the conclusion, like, it's time to focus on user growth again. So they did it, and it went up to 60%. And so that's a fundamentally extraordinary company, and AI is a tailwind for it. And if you look at all the metrics, they're doing perfectly fine. Revenue, cash from operations, DAO growth even has, I mean, it halted to zero in Q2 2021. Go and look at the written form of the update. Nothing to do with what we're seeing today. Today is just a marginal deceleration as they focus on other stuff, which they're doing really well, such as now increasing the quality of teaching and stuff. So across the board, I'm seeing earnings do very well. What I'm not seeing do so well is investor psychology, and that often tends to be to the advantage of the smart investors. So I think smart investors have the emotional discipline to separate the two things, and it's not even hard to do so right now. I would say it was harder to do so in April, because in April we had a macro factor which we couldn't really control and was largely unpredictable. You could make some bets, but then it's the default bet is always to just hold and own extraordinary companies, because for extraordinary companies, when bad macro comes along, they actually turn that into their advantage over time. What we have now is not even bad macro. What we have now is a relatively stagnant economy in the 2.0 sense, or whatever you want to call it. So the analog economy, and then this thing is picking up because it's delivering more value to end customers. And it's relatively obvious to me. Then there's other picks in which valuation is not a concern, such as HIMS, trading at what now, 4 times sales or something like that. Very reasonable. By the way, if you look at Duolingo, a customer of my course was actually saying this today, and he was very right. If you look at Duolingo on a price to sales basis, the valuation maybe is debatable. But if you look at it on a price to free cash flow basis, it's not, because this company is a tremendous cash machine, right? So I continue to use dips in my favor, both to one, stand for my convictions, and two, to add to them. So yesterday I added Duolingo, and it continues to be the case that making money in the stock market is not so much about intelligence. I do think that really the average person has the intelligence to see fundamentals. Like the graphs are just pointing up and to the right. It's very simple. What the average investor maybe doesn't have is the stomach to go through this volatility and so forth. And it's just fascinating to see how over the past 2 to 3 years, the call for a bubble, there's a bubble for speaking about a bubble, right? And so to me, the undercurrent for this next decade, potentially next 5 years, is value creation processes are perpendicular to human nature. So they're non-linear and they work in ways which are essentially driven by network effects, and that is not how our brains work. Our brains do have network effects in a social context, but when we analyze processes and stuff, we as an individual tend to believe that our experience in a network reflects the average health of the network. So as I was saying, there's a lot of people yesterday saying, well, I haven't learned anything in Duolingo. Truth is, you probably didn't learn anything in school either, or you probably don't learn anything when reading on the internet or whatever. There's just a natural, I mean, again, no incremental likability points, but the truth is there's just a distribution. Networks are complex, and so you got to capture the essence, the complete essence of the network. And so for these companies, which are essentially networks, including Palantir, which is evolving into one, I do think that as they continue getting bigger and they continue getting more and better data, AI is going to be a massive tailwind. And so if you look at Duolingo's free cash flow per share and Palantir's and AMD's and everything, I do think that they're going to continue exploding to the upside for the foreseeable future. It doesn't have to be that these companies don't need a good macro environment to increase their free cash flow per share. So one thing that I think I said at the beginning of this video is that purchasing power of the average population has gone down a lot, unfortunately. And I do wish everyone the best. I think you guys that have been following me for a long time know that. And partly I do this to humbly, on my end, enable people to think better. I try myself to think better every day, and I share the content in the hope, among other things, that it can add value in that sense. But purchasing power has gone down a lot. But then the fundamentals of, say, Spotify and Duolingo have actually only improved. And that is because, and this is true for Palantir, and this is true for a lot of the other companies that I'm invested in. It's true for HIMS. It has been absolutely true. That is because these companies have one trait in common, and that is that they are constantly widening the value to price ratio. So they are just constantly delivering more value per dollar spent. And so the thing about the macro economy and there's going to be problems in the economy, therefore let me sell and so forth. It's okay. It's a very finite game with essentially unlimited potential losses and very, very small potential gains, but it's actually oblivious to value creation processes. And then on top of that, if you add the whole network effect thing and how that generates proprietary data, which is the moat of the 21st century, and how that enables these companies to vastly increase their productivity and that of their customers, well, I think it's very much a losing strategy. So we'll see how the market does today. We'll probably continue seeing some chop for the time being, but then I think my bet is that, and I don't really care because if it doesn't happen, I'll just continue buying. But my bet is that ultimately investors look at the fundamentals and sort of understand that our monkey brains are just being overpowered by these value creation processes, which are truly extraordinary. I believe this is an unprecedented time in history. Qualitatively, I find myself talking to ChatGPT a lot. It's a great consultant. If you just talk to it about business things and stuff, it's gonna help you break down your thoughts and everything. And I was actually talking to ChatGPT about this yesterday, and the conversation was very surreal. So I think the writing is on the wall. The fundamentals are doing great. We're going to see a record volume of investors crying and hoping that this is a bubble, because they're certainly not going to invest now. They haven't ever done it. It's, the limitations of human psychology faced with this exponential value creation process is increasingly evident. Thank you very much for joining me. And if you enjoyed this update, this video, could you please share this with someone else? These deep dives and updates are for free. And so the only way this grows is with your help. So thank you very much in advance. Take care. And until next time.